Okay, so I'm going to do a little response video to this. And first of all, this is not a rebuttal video, and I love uneducated economist. I feel like I relate to him. He's a blue collar guy. I'm a blue collar guy. He doesn't. I don't know if he has a college diploma, a 4 year. He doesn't. He probably. I don't know if he has a bachelor's degree. I'm assuming he doesn't, but that I don't have one either. I've done a lot of school for what it's worth. I'm an egghead about history and all that. And I think he mentioned he has dyslexia or something, and I know people that have dyslexia, and that shit sucks. And I know, but on the other side of that, I know one guy. I'm gonna turn on my light. I know one guy who's super duper successful who had bad dyslexia, and I'm gonna leave it at that. But he's like one of the richest people in town, and I live in a very rich town. Just that I'm not rich, but so we got that. So that sucks, and I can relate to that. I have really bad ADHD. So it he makes the point in this video that the inflation is not caused by the well, he says money printing. I don't know if he mentions quantitative easing, but that's what he probably means is quantitative easing, and that's true. I agree, and that's correct. In my opinion, is that the inflation wasn't caused by the quantitative easing directly. But what is the So yes, I agree, and he also says correctly that supply supply problems are the you know biggest cause of the inflation, and I would say possibly um, supply is definitely a big component, and the United States, you know, doesn't produce much of its own, and it's getting more expensive to get things from overseas. And the cost of goods coming from overseas, places like China, where the cost of living has over the last several years been rising quite a bit, has gone up. Shipping costs, energy costs. So true. The supply. So you have the supply, and quantitative easing by itself does not cause it. And he says there will be a glut of certain products. Probably true. Uh, Definitely true for some products. I don't think so for some other very important products. Uh, Energy will remain expensive. Energy is a big part of everybody's bill, and it goes into every single consumer good and service that we purchase. Energy is the fundamental commodity. Food will probably also remain high because food requires a lot of energy to create. There's a lot of energy intensive processes involved in food production. And there's other reasons why food costs will remain high. But I would argue quantitative easing did indirectly contribute to the inflation. So here we have the quantitative easing starting in 2008, going to present day, and here we see Bernanke, the first quantitative easing event. That was a very short event, and after that, they tried to keep it normal. They tried to keep it level, but if you notice in 2011, you see a little spike there. And basically, this was designed not to. It was okay. So the quantitative easing was designed to blow up the stock market, to pump up the stock market. And you can look at a stock at the S&P, and you can see a correlation pretty easily with spikes in quantitative easing with bond prices and stock prices. So we know that the quantitative easing keeps interest rates low. Now, from 2011 to 12, here's Bernanke. he doesn't want to do any more quantitative easing after the first initial spike. You could see that. Then we have Janet Yellen. Janet Yellen was the whole reason. The whole reason Janet Yellen was put in there is because they knew she would do a lot of quantitative easing, and the Charles Schwab's, the bankers that Obama, who was in the pocket of, wanted to inflate the prices of assets, the real estate market, etc. And that was why they did this. It did not go into the real economy for the most part. That's why, during that time, inflation was relatively low. Here we see 2013, Yellen, and we see a fairly shallow slope of inflation. And if you compare this to going back in time to go back here, you can see that the slope in those years was actually shallower than inflation back in the 80s. Okay? So we have that. But the quantitative easing, as we know, kept the interest rates low. That went into, so we have the final quantitative easing we already talked about. Here goes Bernanke, here goes Yellen. Okay, now this is Chairman Powell with the COVID, really it should be called lockdown recession. Now, there was a difference between this quantitative easing here, which was designed to pump up the stock market, and this quantitative easing here, which not only was it done to pump up assets, and it did very nicely, but it was also designed to monetize debt so that the government could spend, didn't mean to do that. Okay, so that the government could spend an inordinate, absolutely ridiculous amount of money. So look at government spending over the past 10 years, 11 years. Let's go back 20 years. Okay, let's go back 20 years. All the way back to 2000. And you see government spending here and there. Here's a little spike here. That was TARP, the bailouts. But look at government spending here. And then look at government spending in 2020. So, this level of government spending wouldn't have been possible without the quantitative easing here, which kept interest rates extremely low, which allowed the government to borrow money, monetizing its own debt, which is a process it's kind of like where we're lending money to ourselves, sort of thing, and because the Fed was purchasing the treasuries that the government was issuing at an alarming rate, at a huge rate, 120 billion a month over all that time. And here we see a massive amount of treasuries being bought. 3 trillion about. We go from 4 million to 4 trillion on the balance sheet to 7 trillion. That's $3 trillion worth of treasuries bought by the Federal Reserve in the period of, let's see. I'm kind of like doing this for the first time. March 4th, 2020, from March 4th, 2020. You can go back a little more. March 4th, 2020 to right around June. So 3 months. In 3 months, the government purchased $3 trillion worth of treasuries, which allowed the federal government to start doing this kind of shit. Oh, let's give everybody some money. Look at the amount of spending here. And a lot of that spending went into disposable personal income. Okay, this is the amount of, I guess this is supposed to be a total amount of, I don't know what this is. Let's see. What is this? Billions of dollars annually. So this is disposable personal income. I'm not sure what the measure is, but just look at the relative increases. So here we see the COVID recession as compared to the previous 5 years, the COVID recession as of compared to the previous about 10 years, the COVID recession going back, let's go back 20 years. Look at this. We've never seen a spike in disposable personal income like this. I can take you all the way back to as far back as this will go. Those are massive spikes in disposable personal income. So we have one ingredient of inflation right here. Demand pull inflation. High demand. People are strapped with cash. That came from all the COVID relief packages, everything from the bailouts, although a lot of that went to the upper echelons and didn't make it into the real economy. We had the stimulus checks. We had rent moratorium. That's a big one. You're putting $1,000 extra in somebody's pocket, at least, and in most places, $1,500 extra at least in every person's pocket that rents every month. That's a huge amount of money. Student loan moratorium. PPP loans, and I had another one earlier. I forget what it was. So that's a huge amount of cash going into the consumer's hands, increasing demand a lot. When people have cash in their pockets and they're not investors and they're not smart with their money, which is most people, they're going to spend it. So there goes the demand pull side of it. But what makes it worse, and going along with what uneducated economist says, here we have productivity growth in percentages. So here's a percent every quarter, productivity growth, okay, for the last 20 years or so. About 21, 22, 23 years. And as you can see, just looking at the graph from about here, we see the last great 6% spike in one quarter following the GFC recession. Okay, which really, I'll hold that thought. So here we have that, and for the rest of the decade of the 2010s, productivity growth remains stagnant. Here we have in Q3 2020, because of the base effects of the COVID lockdown recession, we have a 3%. Then we have a 3.9%. Here we probably have Delta variant or something. I don't know what that was. But anyway, so if you compare this decade to any other decade in history, okay, any other decade, look at the 90s. You had a 5%. You had a recession here, but you had a lot of 4% growth years, okay? You had definitely more productivity growth in the 90s. The 90s wasn't even really the best year for the economy. Look at the 80s. You know, the 80s were just rocking. Okay, look at the 80s here. From 1980, okay, you have some bad times, and you have, look at all this, 4%, 5%. Now, if we go back to even the 70s, the 70s were rocking. Was this the 60s? This is the 60s. Look at the 60s. You have 7% productivity growth. Okay, you have compare any of these decades to the last 10 years. It looks pitiful. Productivity growth is the amount of output per person per hour measured in dollars. This is total output of goods and services that any American is producing. Thus, you have the supply push inflation. Okay, no matter how big our trade deficit gets, okay, we cannot substitute. This is going to have an effect on the supply and demand equation here. Okay, so this is the supply push inflation, which goes back 10 years. The decade of the 2010s was stagnant economically. The real measure of a good economy should be something like productivity, in my opinion. Okay, because that shows you that you're actually making things. Okay, and that's what's a strong economy, not creating wealth out of thin air using, by pumping up asset markets. Okay, that's not a strong economy, but that's what they opted for, and we ended up with a stagnant productivity. So this is the supply side. which I would argue is possibly a bigger component of the overall inflation. And I think what happened is what COVID did is COVID actually kicked it into high gear. We were already facing a precipice, okay, of a problem in our economy. And then the COVID lockdowns here, Q3 20, the COVID lockdowns actually start right here, Q1 2020. But now we're starting to see the hangover from all of that, you know, fiscal stimulus, which made the economy less productive in the long run. Because why would you want to be productive if the government's just going to give you money? Oh, so anyway, so that's my response video, and I'm going to leave it at that. But I think that uneducated economist is right. I just think that, yes, quantitative easing can indirectly contribute to inflation, and it has, and that while we do have a lot of supply push inflation, we also have demand pull inflation. We have both of those. And that's why this inflation crisis is probably going to be particularly problematic. In the 70s, we actually had, going back to the 70s, let's go back, 1970s, here we go, 1970s, starting here, we actually had a lot of rocking quarters. We also had some shitty quarters. I would say overall, to me, looking at this, it looks better or comparable. I would say better than, because look, you have a lot of 2%, 3%, you have a lot of 3% quarters, okay, and you have 2 4% quarters, and then you have a 5 and almost a 6% quarter. Okay, so the 70s had much higher productivity. We also had that was, a similar situation, but not the same. The productivity was all right. So anyway, I am checking out.